But how wild are FOMC days? You ready to take a little sneak peek?
I'm ready.
Let's do it. After the FOMC minutes were released at 1 p.m. Central Standard Time, we saw a lot of two-sided action up until the close. So this is the 78-point range yesterday. The expected move yesterday was about closing range about 55 higher, 55 lower. So we did 78 points. Pretty good. Okay. But that gives you a good idea. We rallied up right on the number at 1 p.m. Central Time, and then we kind of sold off the whole rest of the day till the close. Let's go. They don't obviously know what we did today. With the expected move around 55 points right before the announcement, the S&P closed well within it, despite 2 hours of violent back and forth action. So what does a typical price action look like on FOMC? We thought we would cover this as it's it's timely. That's one. How likely is it that the S&P closes within the expected move? What do you think? How likely?
Well, I mean, it should be 68% of the time, right? I mean, that would be what the market would suggest. I'm going to say it's more like 75%.
Knowing the stats, it can help us set up an expectation for zero DTE trades on FOMC days as well. I mean, especially yesterday, I'm sure the zeros worked out beautiful because it only closed down $5 if you held to the close.
Which is a very hard hold too, by the way. Okay.
Impossible.
All right. So like you got to take these numbers.
If you have defined risk, you'd hold it.
Yeah, if you have defined risk, you had no choice but to hold. But then when you went from a full loser to basically a scratch, do you take it off? Or a smaller winner or a smaller loss, do you take it off? To look at just the closing prices, I know that's all you're going to do, all we're going to have for the study.
It's really hard.
Very hard. It's the point I want to make here.
One of the things we always say is sometimes
you can only learn by doing it. I mean,
sometimes it looks better on paper because in reality, sometimes it's hard to.
Sure.
So we looked at there's a ton of data here. So we looked at the last 4 years of FOMC days, and we observed all of them. We recorded the open, high, low, and close for the day, recorded the expected move for the day. We computed the average price, the intraday change. The average price is a percent of intraday range, and the likelihood of closing above or below the various percentiles. Okay, we're going to give it all to you for the last 4 years of FOMC meetings. So when comparing expected to actual moves on FOMC days, the margin is super thin, just 1 point difference between actual and expected. Now, that shows you how good statistically this stuff is. It's crazy. On FOMC days, the actual intraday price change from open to close represented only 53. That's roughly half of the total price action seen that day. This is kind of the interesting stuff here. Since 2020, the expected move has been plus or minus 50 points average. Okay, that's for 4 years. How many FOMC meetings are there a year like this?
8 regularly scheduled meetings during the year.
8? Okay.
Other meetings as needed.
Right. 8 meetings. Okay, so this is a use case of, let's say, 30 occurrences.
Every 6 weeks.
Okay, so this is 30 occurrences, which I think is pretty good. Average expected move 50. Yesterday was 55. Average price change, close to close, 49. Pretty crazy. Average intraday range, 72. Yesterday was 73. And the average open to close price range as a percent of the full day range, 53. That's really interesting.
And pretty cool.
Yeah. Showing how efficient these markets are. Crazy. When looking where the market finished after all the action, it was actually more likely for the market to close at the bottom end of the range. The likelihood of the market closing in the bottom 10th percentile was roughly double the likelihood of it closing in the top 90th percentile. That's pretty interesting too. It's more likely to close on the lows of the day than the highs of the day. And anywhere in between, well, you can see the numbers here. The 90th percentile is 16 and the 10th percentile is 30. It obviously gets a little bit cleaner along the way. But that's pretty interesting too. I like that stat. Let's go, meaning that there's a better chance closing on a low. Okay, so some of the takeaways. Because the actual move over time was roughly equal to the expected move, the extra volatility priced into the zero DT options on FOMC days is well accounted for. As Tony said, it is well accounted for, but it is also extremely difficult because knowing when to lighten up, oh boy, it's not easy. It's a challenge. There's a lot of two-sided action on FOMC days, with the daily range averaging 2 times the actual daily price range. That's also interesting. And it was twice as likely for the market to close near the bottom end of its daily range than the top end of its daily range. And that was exactly the case yesterday.
Very good. Good little study by the team. Amazing that the numbers always seem to work out, right?